the only way to eliminate risk in the financial sector is not to have a financial sector at all. If you are to have a financial sector that takes the genuine risks that we need taking, you can also be sure it'll take some risks that we don't need. How do you ensure that banks lend for real projects that make a lot of sense, while at the same time the structures that allow them to lend freely don't lead to excessive risk-taking on financial instruments that we saw during the crisis, or an excessive buildup in leverage? I think the dilemma is, to some extent, how do you create that separation? And unfortunately, it may be quite hard. I've been a professor at the University of Chicago since 1991. I was at the IMF for 3.5 years as the economic counselor. I spent 4 years in India recently, culminating as the governor of the Reserve Bank. We're still struggling with a financial sector that we absolutely need to allocate resources both within the country and across the world. We still have to understand the factors that make it volatile and how to constrain the volatility while getting the good stuff from it. I mean, the true problem, in some sense, is liquidity that the financial sector thrives on also breeds leverage. And leverage is eventually problematic. Yes, it's the easiest way to raise resources by issuing debt. But if, in fact, you issue debt, it creates the problems for an eventual downturn if, in fact, you're not able to keep up with debt service. The problem is, more liquidity you have, the more debt that's taken on. These twins are sort of tied at the hip, and you can't break one without breaking the other. On the one hand, we have some countries that have sectors that are highly levered and therefore are not able to create some of the real assets, some of the factories, some of the power plants, the infrastructure that are needed to create jobs and enhance economic growth. There are other countries which are in the process of creating that debt overhang by taking on substantial amounts of leverage beyond what possibly could be sustainable in the longer term. I think industrial countries would be very short-sighted if they erected protectionist barriers today, knowing that their populations are aging and knowing that the rest of the world is getting significantly richer over time, and they will need those markets in the future no matter how development takes place. You do need the rest of the world, both to make investments for your old age, but also potentially for the migrants that will help sustain an older population in some of these richer countries. Too much of the burden for reviving growth has fallen on the shoulders of the central bankers, partly because they are the only unelected group in charge of policy and therefore have the policy tools ready at hand and can undertake them. I think they've perhaps been forced into territory where the effectiveness of the tools could be questioned and are in fact being questioned. Because politics is dysfunctional, it cannot get its act together, leaving central bankers to sort of expand beyond their natural space, and then the politician gets angry because the central banker is intruding on their space, wants to push them back, but is not offering the policy intervention that would push the central banker back. And I think this is partly also precipitating some of the angst amongst these populist movements against central bankers. Are they taking up too much? And I would argue that we're probably at the point we should be thinking very seriously about pulling back. I think the problem with any such debt-to-equity conversion is who bears the costs. Typically what you find is that the first level of such debt-equity conversions look good. It liberates the person who's laboring under a huge amount of debt to make investments and so on. But then who does it land up on? Who takes the hit? If it is, say, a bank, then the next question you have to ask is, does this bank become undercapitalized as a result? So does the bank then stop lending? If you don't want it to stop lending, who's going to provide the capital to the bank? Once you walk through these scenarios, it is a lot more complicated than the first round effect of the debt relief. That said, it seems to me that sometimes we find all sorts of complicated ways of trying to achieve this debt relief, which tend to have much wider effects, adverse effects. Perhaps we should be more direct about where do we need to do it, What are the resources we need? Let's bring them to bear and see this as a one-off. Every once in a while, when debt becomes too high, there is a process by which it's written down, but making sure that it's written down in the right places and there's a fair sharing of that process, of that debt. There may be some virtue to thinking about that. Economics, as with every profession, is a process of narrowing down to try and get at the areas that you should completely focus on. But you shouldn't narrow down so much that you miss some of the bigger pieces that you've left aside in the process of narrowing down. The narrowing down of economics in the 70s, the 60s, 70s, and 80s was in reaction to the verbal compendiums that used to be called economics before, which were too big, too loose to get a handle on. But I think we've gone so far down, now we have to step back and say, what are we missing out? Economies live in society. What aspects of society are we missing out? I mean, we just talked about missing out the whole financial sector, the social sector, the political environment. How do we bring all these back to bear so that we can get a much better grasp of how economies actually work?